Let me ask you something. You've heard Nvidia is one of the best performing stocks of the decade. You know Amazon changed how the world shops. You believe in Microsoft and AI long term. But when you go to actually buy, you see $192, $232, $372 per share. And even though fractional shares exist, something in your brain says that ship has already sailed. The people who got rich from those stocks bought them 10 years ago. Not me, not now. Here's the thing. That feeling that the obvious winners are already priced in is actually the beginning of how serious investors find the next generation of opportunities. Because right now, in July 2026, there are 7 companies trading under $20 a share. Some under $10, with real revenue, real growth, and real catalysts that most retail investors have never heard of. Not because they are bad companies, because they are small enough that Wall Street hasn't fully priced in what they could become. Today we're looking at all 7 with a clear-eyed view of the risks. My name is Yang and I cover crypto, investing, and personal finance, including the parts of the market that don't get covered in the mainstream financial media. If you're looking for the kind of stock research that goes beyond the obvious large cap names, hit subscribe and give this a thumbs up if this helps. And before we go anywhere, one very important thing. This is not a financial advice. These are research ideas based on publicly available data. Small cap stocks carry higher risk than large cap stocks. Never invest money you can't afford to lose. Every single stock on this list carries real downside risk. And I'm going to tell you exactly what those risks are, because the goal here is not hype, it's the honest picture. Let's build the list. First, a quick framework. Because stocks under $20 sounds like a gambling category, well, it isn't. Here's the actual logic. Small cap stocks, defined as companies with market capitalizations between $250 million and $2 billion, occupy a sweet spot. They're big enough to be generating significant revenue and getting real analyst coverage. But they are small enough that Wall Street hasn't fully priced in their potential. The math behind this matters. For a company worth $500 million, it is easier for it to double revenue than it is for a company that's worth $500 billion. The addressable market compared to the size of the company is much bigger. When a small company manages to double their revenues, their share prices do not instantly double. The trade-off is real though. Small cap stocks offer higher growth potential than larger companies, but with greater risk of volatility. More and bigger fluctuations in stock prices and earnings reports. It can also be more fertile territory for fraudulent activity. That's why we're not just looking for cheap stocks. We're looking for cheap stocks with verifiable revenue growth, a large addressable market, and a specific catalyst that could drive the next move up. Here are 7 of them. Let's go. Number 1, Serve Robotics. Ticker is Serve. This company was spun off from Uber in 2021 and still counts Uber as a major investor. Its delivery robots collaborate with the Uber Eats platform, delivering restaurant orders from chains like Shake Shack, and in October 2025, it signed a deal with DoorDash, expanding its addressable market. Revenue is currently more than tripling year over year, and they are targeting $26 million in full year 2026 from $3 million quarterly revenue. The growth catalyst, autonomous delivery, is moving from novelty to infrastructure. Every major food delivery platform needs a hardware partner. Serve Robotics has 2 of the 3 biggest, Uber Eats and DoorDash, already signed. However, this is still a development stage company, not yet profitable. A missed revenue target or a partnership pullback could crush the stock price quickly. The current price is $6. Number 2, Nokia. Ticker is NOK, and the current price is $13. This one surprises people. Nokia, yes, the phone company, is no longer a phone company. It's one of the world's largest 5G infrastructure providers. Nokia has a portfolio of around 20,000 patents, of which 7,000 are essential for 5G. In November 2025, Nokia unveiled the strategy to lead the AI-driven transformation of networks and capitalize on the AI supercycle. Its deal win rate is encouraging, with notable successes in key 5G markets, including the US and China. Here's where it gets really interesting. Nokia has a stable balance sheet with 4.89 billion euros in cash and cash equivalents as of September 2025, against long-term liabilities of only 2.34 billion euros. It's essentially a cash-rich infrastructure company trading at a fraction of its US competitors' valuations. However, investors still associate Nokia with outdated phones. If institutional money doesn't re-rate the stock, it could stay undervalued indefinitely despite improving fundamentals. Number 3, Evercoat, ticker EVER. The current price is $23. Evercoat operates an online marketplace that connects insurance carriers and agents with consumers shopping for coverage. So far in 2026, EVER stock has gained 34.3%, comparing favorably to the S&P 500 16.3% rise in the same period. It carries a Zacks rank number 1, but with the growth score of A and the value score of B. The company is investing in AI-driven tools, including smart campaigns to improve advertising efficiency and deepen customer engagement. Analysts project 19.1% earnings growth year-over-year and 14.4% revenue growth in 2026, with longer-term targets to surpass $1 billion in annual revenue. Insurance is a $1 trillion industry going through digital transformation. Evercoat is the infrastructure connecting consumers and carriers, and it's doing it with AI tools that improve conversion rates, which is a compounding advantage over time. What? The insurance spending is cyclical. If carriers pull back on acquisition budgets during economic stress, Evercoat's revenue slows quickly. Number 4 is the metals company. The ticker is TMC. Current price is $4. This is the most speculative one on the list. I want to be very honest about that. The metals company controls 51 million metric tons of battery metal reserves on the ocean floor. That's worth potentially $600 billion using copper as a proxy, and potentially over $1 trillion when other valuable minerals like nickel and cobalt are factored in. The company targets commercial production by late 2027 and is valued at $3.7 billion, despite holding what some analysts describe as the world's largest undeveloped battery metal deposit. As demand for EVs and battery storage explodes, cobalt, nickel, and copper become increasingly strategic resources. TMC owns the deposit. The question is whether it gets the permits to mine it. Remember this, permitting is uncertain, environmental opposition is real. If commercial production is delayed past 2028 or 2029, this could be a very long wait for a return. This is not a stock for your core portfolio. Number 5, Lantronix, ticker is LTRX. The current price is $5. According to TradingView, Lantronix has surged 48.8% over the past year, carries a Zacks growth score of A, and has had earnings estimates move up to 42.9% for the current year and 90% for the next year. The company has a trailing 4-quarter earnings surprise of 16.7% on average. Lantronix provides device networking and IoT infrastructure, the plumbing that connects industrial equipment, retail systems, and security devices to networks. As IoT spending accelerates across manufacturing and logistics, companies like Lantronix are the picks and shovels play. However, this is a small company in a competitive infrastructure space. Larger players like Cisco can enter its markets at any time. Execution risk is real here. Number 6, Tigo Energy. The ticker is TYGO or Tigo. The current price is $2. Tigo develops intelligent solar energy products, including energy storage systems, inverters, forecasting software, monitoring tools, and EV charging solutions. Unlike some clean energy companies, Tigo has already achieved modest profitability while continuing to expand. Revenue is projected to grow at roughly 20% annually through fiscal 2026 and 2027, and shares have surged more than 200% in the last 12 months. Solar is a category with massive long-term tailwinds regardless of short-term policy shifts. Tigo's edge is that it makes the existing solar panel infrastructure smarter and more efficient, which means its addressable market is every solar installation in the world, not just new ones. However, the policy risk is real. Clean energy subsidies could change, and competition in solar optimization is intensifying from larger players. Number 7 is Orion Group Holdings. The ticker is ORN. The current price is $16. This one is the least flashy and arguably the most overlooked. With a market capitalization of over $600 million, Orion Group operates as a specialty construction company focused on marine and concrete services, supporting infrastructure projects across transportation, ports, defense, and industrial end markets. The company benefits from exposure to public and private infrastructure investment, where long project cycles and specialized capabilities support demand visibility. Activity across marine and concrete markets has remained steady, supported by federal, state, and commercial spending. As the U.S. continues its infrastructure investment cycle, ports, bridges, military facilities, Orion Group is executing on long-term government contracts. This is the boring, cash-generating side of small-cap investing that institutional money tends to undervalue. The risk is that project delays, cost overruns, and government contract cancellations. Construction is a cyclical business with thin margins. Okay, so you have 7 names. Here's what I'd actually suggest doing with this information, because buying all 7 blindly is not the move. Step 1. Research before you buy. For each stock, pull up the financial stub on Yahoo Finance. Check if the revenue is growing. Is the company burning cash faster than it's earning it? How much cash runway does it have? Never buy a small cap stock without understanding its cash position. Step number 2. Size your positions for the risk. If your portfolio is $1,000, don't put $500 in one speculative small cap. A position size of $50 to $150 per name in a high-risk stock is rational. The upside can still be meaningful if the thesis plays out. The downside is contained if it doesn't. Step number 3. Set a thesis and an exit rule. Before you buy any of this, write down in one sentence why you're buying it. Then write down what would make you sell. For example, I'm buying Serve because food delivery robotics is scaling fast and they have 2 of the 3 major platforms signed. I'll sell if they lose a major partnership or miss revenue targets by more than 20% 2 quarters in a row. A thesis protects you from emotion. Here's the honest summary. 7 stocks, 7 different sectors, 7 different risk profiles. What they have in common: real revenue, real growth catalysts, and prices that most retail investors dismissed because the numbers seemed small. The biggest multi-baggers in history: Amazon in 1997, Netflix in 2004, Bitcoin in 2011, didn't look like obvious winners at the time. They looked like small, risky, easily dismissed ideas. The people who did the research, sized their positions appropriately, and held with conviction are the ones telling those stories now. You don't need to pick all 7, you need to pick the 1 or 2 that you understand, and size them in a way that lets you hold through volatility. If this video helped you find a research starting point that felt different, please hit the like button. It helps more people find this content. Subscribe and hit the bell. Every week, I break down investing ideas across crypto, stocks, and personal finance for people who want to get ahead. Drop a comment below which of these 7 catches your attention the most and why. I read every single comment. See you in the next one. Bye!